welcome everybody. I want to thank our presenters who have done a lot of work preparing. That's Mike Durkin, Laurie Griffith, Wendy Lewis, and Patti. It's been a privilege of our firm to advise so many of you on accounting and tax matters, and particularly through the pandemic. We've been experts at things that we never dreamed about, and PPP, ERC, EIDL loans, you name it. We're also very appreciative of the AICPA, which has something we've paid dues for all our lives. And since the pandemic, they started a semi-monthly town hall, and they have been phenomenal at providing us the most current information, including economic experts, IRS leaders, members of Congress, and just people in the accounting profession. So we're able to stay on top of it. Our firm with 30 something people is, believe it or not, we're part of what's called the G400 of accounting firms. So that's firms that are between 101 and 500 largest accounting firms in the country. And so that tells you that there's probably a lot of accounting firms that are like the top 100. And then, you know, for us to be in that list with only 30 something people shows the way the accounting industry has been split up. I participate in a managing partner survey, which every year with part of the G400, they report all the issues that accounting firms have. And in 2022, for the first time in history, number 2 on the list was dealing with tax notices and tax issues and getting a hold of taxing authorities. It's something that's never hit the list before. And the survey indicated that something like 2/3 of those notices are wrong. So if you get a notice, join the club. I know that I've gotten one. I know at least 2 of my other partners have received notices that were incorrect. So don't freak out when you get a tax notice. Just send them on. Mike Durkin is going to speak a little bit on the pass-through entity tax. And I will tell you that our firm saw this as a huge issue, and we got actively involved in trying to get Missouri to get on board with the pass-through entity tax. And Mike and Patti and Jim Owens and I, we both hired Thompson Coburn and had meetings with the director of the Missouri Department of Revenue and some of the other people from the Missouri Department of Revenue. And in July of this year, Missouri signed the pass-through entity tax. PTET is what we refer to it. Mike will talk a little bit about that. So, and I have received calls from some of the national accounting firms thanking us for our lead in helping this. So something we're pretty proud of through our office. So with that, Mike, you're first.
All right, perfect. So this pass-through entity tax probably is the biggest tax law change for most of our business clients since the 2017, effective 2018 Tax Cuts and Jobs Act. And this impacts flow-through entities and their owners. So S corporations, partnerships, LLCs, which are usually taxed as partnerships. And it really is pretty significant in terms of the tax savings that is out there, you know, for business owners. So what it is effectively is currently on your individual tax return, you're limited to a $10,000 deduction for all state and local taxes. So that includes real estate tax, personal property tax, your Missouri state income tax. So you're capped at $10,000 whether you pay, you know, $10,000 or $1 million in state taxes. you can't deduct more than 10,000. So this is a way around that, specifically to your K-1 income from a partnership or S corporation. And Missouri made it effective beginning this year. They passed the law in May, the governor signed it in July, and it's effective for tax years beginning on or after 1/1 of 2022. So essentially what it does is now your state taxes are paid by the business. So they're paid by the partnership or S corporation, and they're deducted by the business. So you're no longer limited to that $10,000 cap. You get to deduct the taxes in full on the business return. So Missouri is not the only state that has this. In fact, there's 29 states that have this law on the books for 2022 and before. Some states like California and New York had it before. You can kind of see the chart there. A lot were effective for 2022, in part because the IRS didn't bless this approach until December of 2020. They issued a notice that basically said, yes, we're okay with this arrangement. You know, it is a way to circumvent the current $10,000 cap, but we'll let you do it anyways through this mechanism. So all of these states have this pass-through entity tax that are in blue. And it's been quite beneficial for a number of our clients, from, you know, tens of thousands of dollars of deductions to multi-millions of dollars for some clients. So the key thing to know is that every state is handling this differently. Some states, you make the election when you file the return. Some states like California, you actually have to do it by June 15th for the year. Otherwise, you can't make the election. New York has similar rules. Some states make you pay estimated payments. Some states don't. Some states, if you're a non-resident, you don't have to file an income tax return in that state anymore if you make this election. Some states still do. So it's really all over the board, kind of like state tax law is in general. You know, every state does things differently. So, you know, we've been communicating this to all of our clients who are impacted, who we think will have a big impact. And, you know, if you're not our client, we'd love to talk to you about it, but certainly bring it up with, you know, whoever you work with, or if you're an advisor, an attorney, a financial advisor, this should be on your radar too if you're dealing with business owner clients. So Missouri, the mechanics of it, it's the same tax rate as the individual tax rate. You still get your Missouri business income deduction on that income. A planning point that we've been working with some clients on is if you're a cash basis taxpayer and are going to have a large payment due for this tax, you want to pay it before December 31st of this year so that you can claim the deduction this year. You can pay it next year. Missouri doesn't make estimated payments, so you can pay it in April when you file the return. But if you want the deduction this year instead of next year, you have to pay the tax this year. So there's a mechanism for doing that. And actually last night, Missouri released the official form to make a payment. So that's not reflected here. You were supposed to use the corporate estimated tax form before that, but they actually released an official form last night. So that's now available that we'll be using for clients. It's called the PTE Anticipated Payment Form. Kind of a mouthful, right? But so we were using the next form on the next page to make these payments. That's kind of an example. They basically wanted you to use a corporate form and write that pass-through entity anticipated tax payment wording on it. But now there's an actual form, so it's much easier to handle. You know, a planning point around this. Oh, here's a chart that just shows an example, you know, based on your pass-through income, what the effective tax savings are. And you can see it's pretty significant. If you have $1 million of income and you get a $53,000 tax deduction now that you would have otherwise lost, that's $20,000 of actual cash tax savings that could apply. So, you know, extrapolate that up or down either way, depending on your income level. And you can see that it has a pretty big impact, especially, you know, we've seen a number of clients who maybe have sold a business or sold significant real estate in 2022. And this is offering some really big savings for them. So always keep us aware, if your circumstances are changing. We've reviewed all of our client lists and kind of gone through what we know and are working diligently to inform everyone who could be impacted. So Schedule C filers, so that's just your sole proprietor or single member LLC. There is a planning opportunity here where maybe you could elect to be taxed as an S corporation to take advantage of this, or you could bring in a spouse or a general manager of an LLC who's someone else or a different entity to now have a multi-member LLC and be taxed as a flow-through entity instead of a Schedule C. So this would allow you to take advantage of that. Now there's costs with an additional tax return, maybe additional payroll, legal fees and whatnot. So we kind of, have analyzed it and think, unless you're at 300,000 or so of income or more, it probably doesn't make sense. Part of that is because the tax law goes back, assuming there aren't any changes, it goes back in 2026 to the old law where you can deduct your state and local taxes. So this is only a 4-year benefit essentially. So it doesn't make sense to change around too much unless the dollars are significant. So, this is probably the biggest item aside from all the government PPP, ERC programs that'll impact our client base. And it's definitely something that we should all be aware of and make note of. And like I said, we're happy to work with anyone on understanding the impact of it. So I think our next topic is going to be ERC, and Laurie is going to come up here too. She's kind of been leading this for a lot of our clients, and this is a pandemic program, but we're finding that, a number of clients, especially new clients to the firm, have not taken advantage of this, even if they are eligible, and we're still filing amended payroll tax returns to claim this credit. You have 3 years from when the returns were due to file for the ERC. So it's a 2020 and 2021 item.
So it is a refundable tax credit. It is a credit that you would take on your 941. So you would amend your 941 tax return to be able to take the credit. And it is a loan. So this is different than the PPP, as most of you are aware of the PPP loan. This does not have to be paid back. Who is eligible? In 2020, basically, if you're considered a small employer, if you had less than 100 full-time employees. If you have more than 100 full-time employees, you're only eligible for the wages that you pay to an individual that individual is no longer working. So if they're out for whatever reason, then the wages that are qualified are if you are over those limits. In 2021, that threshold increases from 100 employees to 500 employees. Note that it does say full-time employees. A lot of people are familiar with the term full-time equivalents. This is not a full-time equivalent. Basically, if your employee works 30 hours per week or 130 hours per month, then they would be considered a full-time employee. So not that you have to take all of your employees, add up the total hours. This is considered just the full-time employees. So some key items. This qualifies for the effective for 2020 based on dates of 3/13. So that's basically when they considered, pretty much a lot of the people were considered shut down. In 2021, the time period the wages are effective is 1/1 through September 30th. There are some additional ERC credits available if you're a new company. Basically, if you're a startup, those do qualify after September 30th, 2021, and do go through 12/31. But most of the time, we're dealing with a lot of the people wages up through that September 30th cutoff. Who qualifies? So basically, any private sector business or tax exempt organization that carry on a trade or business, or if they're tax exempt. You have to have operations that were fully or partially suspended in any calendar quarter due to government orders that are limiting commerce, travel, group meetings. Basically, if you're under a partial shutdown that's provided by the government, then you could qualify. or you would experience a significant decline in gross receipts during that calendar quarter. The suspension of operations must be more than a nominal effect. So basically they define nominal as more than 10%. So something that you're under a shutdown, we'll get into some examples. Basically, if the restaurant, is closed and maybe the indoor dining is closed, that's more likely than going to be a nominal percent of 10%. Therefore, you would qualify for the shutdown. Businesses that are required to reduce operating, basically they have to do some deep cleaning. They're required to reduce their occupancy. Those are all eligible for the credit. If your customers are just required to stay at home, you would not be able to qualify for the credit. That's not one of the criteria. It has to be a government order shutting down the actual business. Also, if your employees are just eligible to work from home, that does not qualify you for the credit. Decline in gross receipts. What that is it states that in 2020, your gross receipts must be less than 50% of the gross receipts compared to the same calendar quarter in 2019. What that also allows you to do is you remain eligible until your gross receipts are at least 80% of the same quarter for that next period. So that gets a little bit confusing, but basically it says you qualify in the first quarter and you continue to qualify that next quarter. So most likely if you qualify in 2020, you're going to qualify for 2 quarters at least, because you qualify until at least that end of that next quarter, until your gross receipts are at least above 80%. So 2020, you're going to likely, if you qualify based on the gross revenue, your total gross revenue compared to 2019, you would get 2 quarters in 2020. In 2021, that gross receipts test goes to 20%. So you look at your gross receipts for any calendar quarter, compare it back to 2019. If your gross receipts are at least the 20% decrease, then you would be able to qualify for 2021. In 2021, there is an alternative election that basically says, well, if you qualify based on your gross receipts in a quarter, you can use the alternative quarter. So for instance, maybe in 2021, your second quarter receipts are not down, but your first quarter receipts are. You would then be able to qualify for that first quarter in addition to the second quarter, because you're looking at that prior quarter to determine your eligibility. There are some special rules, again, for those that were not in existence for 2019. So maybe you're a new business in 2020, 2021. There are some special rules. We just didn't go into those yet. So the credit is calculated based off of 50% of qualified wages. So the qualified wages also include healthcare costs. So basically you take a look at what your wages are. The wages are limited to $10,000 in 2020 per employee. So you look at what your wages are over each quarter and determine where each quarter, how much do you qualify? So if you pay an employee $10,000, the credit is 50%. You would amend your 941 tax returns based on the wages paid in each quarter, and the credit you would get for the year is $5,000. So keep in mind that is per year. In 2021, that credit is increased to 70% of the wages. Still limited to the $10,000, but that $10,000 in 2021 goes to per quarter versus per year. So you can definitely see there's some savings there, $7,000 per employee per quarter. Keep in mind now that's 3 quarters in 2021 that you would be eligible for. So you may have heard the commercials on the TV, radio, that people can save up to $26,000. So you can see $7,000 for the 3 quarters in 2021, plus the $5,000 in 2020 gets you to your $26,000 that you could be eligible for. So here's some just various calculations. 5 employees at $5,000. So this would be the 2021 example. your ERC credit would be $35,000. Up to 10 employees, your credit could be 70,000. And if you had 50 employees, that total credit that you would have is $350,000. Some additional information. If you're a related employer, so that basically says you're a brother, sister, there's some aggregation rules that state you have to own a certain percent out of a different company. You're required to aggregate the revenue and the number of employees amongst all your companies. That does sometimes prove to be a benefit. We've had, for instance, a restaurant where the restaurant was under a partial shutdown, but the grocery store was not. They were able to aggregate all companies and qualify against all, they actually own 5 different types of companies, and they were able to qualify for this amongst all their companies. So it can certainly prove to be a benefit. Could go the other way too. If they didn't meet the revenue test, that could be something that could hold them back if they don't qualify under a government shutdown. PPP loan. So most of you have heard the Paycheck Protection Program. That's a loan that was offered in 2020 and 2021. It used to be that you would not qualify for the ERC if you had that loan. They have now come back and said you do qualify. You just cannot use the same wages that you used for the PPP loan that you do for the ERC credit. So that does require you to do a calculation, basically taking a look at that $10,000 for 2020. How much of that did you use for your PPP loan versus how much of that can you use for the ERC credit? The timing, so you do have, so this credit does get reported on a 941X. So you are required to amend your 941. So a lot of times those are the forms that the payroll companies are preparing for you. So you do file a 941X. This is something that does need to be paper filed. And you have up to 3 years after the original payroll tax return was due to be able to file this tax return. The one item to note is this ERC credit is taxable. So you do, if you're amending your tax returns now, your payroll tax returns, you would be required to likely go back and amend your income tax returns for the company also. Again, like I said before, watch out for the ERC credit mills. There's a lot of third parties that basically don't even know anything about your business and are going to say that you qualify. We've been on a lot of AICPA, the webinars that Alan was referring to earlier, and they are saying be cautious, right? Just because they say you qualify, have some documentation, verify. A lot of people are saying, oh, well, I wasn't able to get product. Well, just because you're not able to get your product, your suppliers technically need to be under that shutdown. So be cautious. They charge upfront or contingent fees, so a lot of times that's just them coming in. They're probably not going to be around in 2 to 3 years. They're probably a company that maybe have just started. They'll go away and you're going to be stuck with trying to prove the fact that you had reason to amend your 941s and qualify. This is not something that you apply for. You just amend your 941s. Likely the reason you're going to be denied is if they come in and audit you.
I think the key is it varies so much based on facts and circumstances. And it truly has to be due to a government shutdown or government mandate. Like Laurie said, it can't just be because you didn't get supplies because of general supply chain issues or things like that. Or that, you had to wear a mask in your office, or that you chose not to have in-person meetings. Those don't really qualify you. We've seen some cases where businesses were forced to have limited hours that could qualify you, where parts of your business were closed, like a dealership had to close sales, but not parts and service. That qualifies you. So there's a lot of different fact patterns. The easiest, of course, is meeting the revenue decline thresholds. But if you don't meet that, there are other ways to qualify. And you can qualify for certain periods of time. So maybe you were subject to orders for a month. Well, you would qualify for that month, but not the following month. So it just varies so much, and it should definitely be looked at. And the dollar amount can be huge in 2021 at $7,000 per employee per quarter. So, I mean, we've certainly seen millions of dollars for some clients. I think Wendy is up next on year-end planning.
Good morning. All right, let's touch base on a few ideas for individuals that can do before the end of the year. One concept is to tried and true to defer income or accelerate expenses if possible. And as we transition between 2022 and 2023, it may be slightly more beneficial than usual because the IRS has increased the tax brackets by 8% and incomes aren't as likely to increase by quite as much. Some people may already be aware because this is a common strategy we've been recommending to our clients. It's called a bunching strategy. It's since they a couple of years ago increased the standard deduction, what we've suggested is to think about your taxes over a 3-year period. And in year one, if you're charitably inclined anyway, bunching strategy for charitable donations, to donate like 3 years worth of what you would normally contribute over a 3-year period, but do it all in 1 year. And then in year 2, take the standard deduction. And in year 3, take the standard deduction. And over the 3-year period, you've maximized your deductions. Another idea is to gift appreciated stock. You get a deduction for the fair market value of the stock on the date of donation. And the gain is excluded from your income. And that's nice because adjusted gross income, there's a lot of other limitations that pivot around this number. So it's nice to keep that number down. Another strategy for that is if you have an IRA, especially if you're already in your RMD space, to gift to the charity directly out of your IRA account. That avoids limitations on your itemized deductions to some degree and then keeps it out of your income. Of course, we want to fund our education plans before the end of the year, especially if it's a 529 plan, because Missouri gives us a deduction for that. We want to pay our college tuition so we can take that credit this year if we qualify for that. We're in the proper income levels. And what's a little more attractive this year, if anyone currently has a traditional IRA and has ever been considering converting it to a Roth, with the decline in the market this year, it's attractive because you can move more into your Roth account and keep your income lower because the values are lower. And then when the market returns, that appreciation will be sheltered from tax. All right, a few tips for businesses. There's going to be a change in the research and development expenditures, which Patty's going to cover for us later, but it might make sense to go ahead and accelerate those expenses into 2022 if you can, because that's law is going to change. And as Mike mentioned, for your partnerships and S Corps, consider making the state payments for your partners because that's very advantageous. Bonuses changing next year. We currently have 100% bonus. We've had 100% bonus for a few years, but it's going to drop next year to 80% and then decrease 20% per year thereafter till it gets to 0. So if you have equipment that needs to be replaced, I wouldn't say spend the money just because you can expense it next year, but if that's a need, we go ahead and consider accelerating that this year. The next point is Missouri has some interesting programs. I have a link to the website there for you that are charitable programs that you can contribute to, and then Missouri gives you a credit on your Missouri return. This isn't a dollar for dollar, like it doesn't really save you dollars, but it feels better to contribute your money to a charitable fund or purpose as opposed to paying the federal government, state government. All right, so we did get some new legislation, other legislation this year, the Inflation Reduction Act, we call the IRA. The first 2 points on my slide, they don't really impact the businesses at our client base because their first one is for publicly traded partnerships. And then the next one is corporations of income over $1 billion. But I just wanted to bring them up because these, when they pass new acts, they try to keep the budget neutral. So these are the revenue producing aspects of the act and to pay for the deductions and the credits, and to pay for increasing IRS funding, which they plan on doing as well. Right, so as part of this act, they extended a law that we already had in place, but they extended it through 2028. And it's called the Excess Business Loss Limitations. And this puts a cap on the amount of losses we can deduct from our trader businesses. It only includes the operating losses. It won't include capital gain losses, or you won't get to net your employment income if you get a W-2 from that business. The next slide I put in here because it's interesting to me, and it's a visual of how difficult it is to deduct losses on your personal return from your business. And so we have 3 hoops to jump through before we even get to this one that they extended. So there's a lot of challenges and complexity in deducting a loss from a business on our returns. So in the act, they appropriated the IRS $80 billion of additional funding. And they state that they're going to hire 87,000 additional agents, of which they claim over half of those will be to replace retiring employees over the next 5 years. They desire to close the tax gap, and so they're going to start increasing examinations. They claim that it will be only for individuals making over 400,000. So for individuals making under, they won't be affected. They're going to go after larger corporations and pass-through entities. And they're going to look at virtual currency transactions and cross-border activities. So these are their hot points. They intend to also spend the money to upgrade their technology, which is definitely needed. And they're going to hire customer service representatives. And I found that they recently added about 4,000 representatives, but judging by our hold times and the lack of response to our notices, they must all still be in training. This is just a visual of the breakdown of where the tax gap exists on the different tax types. This is kind of old information, but that's what I could find. But that's all right. Moving on to what I call, in my mind, the feel-good legislation. These are motivating taxpayers to purchase energy clean vehicles or make improvements to their home that conserve energy. And the first one up is for purchasing a new energy efficient vehicle, or I guess clean energy vehicle. The purpose of these credits is really to try to motivate more middle class taxpayers to purchase vehicles. Previously, the electric vehicles have been more popular with the wealthy clients. And so this is an attempt to get more people on board. It is effective for vehicles purchased starting in January through 2032. Potential credit maximum is $7,500. It's got a breakdown in 2 components, depending on the minerals in the battery or the components of the battery. So there's a lot of behind the scene nuances with what cars qualify. There's some income limitations. So only certain taxpayers can claim depending on your adjusted gross income. There's also limits on which vehicles apply. So after a certain price point, then they won't qualify for the credit. And probably one of the most important takeaways for here is that this link to this website, because one of the requirements, is the final assembly needs to be done in North America. And so this website is very helpful because I have a slide on this one. It shows a list of vehicles that qualify. And then more importantly, it has a VIN decoder lookup. So once you finally decide on which vehicle, I recommend popping that number into here before you pull the trigger to confirm that it does qualify for the credit. All right, they've also added a credit for clean vehicles that were previously owned. And we have the same effective date as for the new vehicles. The credit is going to be the lesser of $4,000 or 30% of the purchase price. We got some income limits here too, which are lower. And they define a previously owned vehicle as being at least 2 years old. It was owned by someone other than the taxpayer originally. It weighs less than 14,000 pounds. And it needs to be sold in a qualified sale, which means by a dealer. So individual to individual is not going to qualify. And the sales price needs to be less than $25,000. And if that vehicle had a credit claimed on it in the past 3 years, then it's not going to qualify for the credit. And with all these credits, we have to put the VIN number on the tax return. So I'm assuming that the IRS is going to be tracking this somehow. Yeah, so the dealers and the manufacturers have to turn in all the VIN numbers for the vehicles to the IRS. All right, so they also have created a credit for commercials, so commercial vehicles. Again, we have the same effective date. This will be for vehicles that have a battery capacity of over or 4 kilowatts or more per hour. The credit will be either 15% of the cost of the vehicle. You can use 30 if it's not run by gas or diesel at all. I guess it's the lesser of these two, sorry, 15% or the incremental cost of the vehicle, which we are kind of waiting on some more guidance on that. But at this point, it says the price of the electric vehicle versus the same size use of a gasoline or diesel engine. And that difference is the incremental cost. These are credits that will be claimed by the business. So we will be required to also reduce the basis of the vehicle by any credit that we could claim. All right, so obviously if you're buying an electric vehicle, you're going to need a charger, and they have created credits for the purchase of the charger too, or I guess they extended the credit. There was already previously a credit. We've got the same effective date as the new vehicles. If the charger is installed in the main home, then the credit is the lesser of 30% of the cost, or $1,000. If it's installed in a business, the credit is, actually I have a typo here. It's 6%, they changed it, so not 30%, but the 100,000 is right. So it's the lesser of 6% of the cost, or 100,000. And again, if we're dealing with business property, we'll have to reduce the basis of that property. Okay, so moving forward to some credits for improvements to our buildings. This is a residential credit. The first one applies to specific properties. So we're talking about our solar, fuel cell, small wind, geothermal kind of property. These improvements need to be made to what it says is a dwelling unit. So a place where the taxpayer lives, but it can also include their vacation home, or if they happen to be renting and they're a tenant and they wanted to make improvements on that property. Seems kind of unlikely, but that would qualify for the credit as well. This is effective starting, they made it retroactive, so it's effective for 2022. And the credits for this year will be 30% of the cost, which runs through 2032. Right, and then there's another type of credit which is a little smaller, and it's not effective till next year. This is for improvements to a principal residence. So for this credit, you need to actually be living in the home and you need to own the home. The credit is 30% of the cost, but there's some very small annual limits depending on the specific property that you're putting in service. Windows and skylights are 60. Exterior doors are 250, but we only can take 2 doors. The over annual credit limit is $1,200. And for this property, it must meet Energy Star certifications. So my recommendation is similar to the vehicles. I would do your research first to make sure that it's the proper Energy Star rating and will qualify for the credits. There's a lot of detail in that. And with that, that's my time. I'm going to turn it over to Pat.
Good morning. Alan introduced me as Patti, and just so you know, Patti Myers. I'm going to talk about all things research and development expenses. Super exciting topic for some people, and for others, if you don't own a business, not so much. But so I'll start with the bad news and then get to the good news. The bad news, for federal purposes, we're going to start in 2022. We're required to capitalize those expenses for R&D, which means essentially, before 2022, we would expense them for tax purposes. Now we need to capitalize them. That means we amortize them over 5 years if they're US expenses, 15 if they're foreign expenses. So clearly that is unfavorable for tax purposes. One thing also to understand is this amortization continues all 5 years. So even if the activity, let's say you did an R&D project, that project is scrapped or abandoned, you still need to amortize that, continue to amortize that cost over the full period. So not great. Also, in terms of what is foreign, that you're going to look at where the costs were incurred, where the activity was done, whether that's foreign or domestic. So if you are a business that has both foreign and domestic, you'll want to be able to identify, a lot of times there are different cost centers or branches, and your cost accounting already provides for that. But that's something that we will need to know how to capitalize that. In terms of what is a research, they call it research and experimentation, but what is an R&D expense, it's section 174. And it talks about an activity that has the intention to discover information that would eliminate uncertainty on the development project. So that's a lot of words, but essentially uncertainty, when you look at uncertainty, you want to look at uncertainty as in, did I know if I could do the project? Did I know, that's one level, but you could also say, did I know, I knew I could, but I wasn't sure the appropriate design. So I need to go through a process to determine how we're going to do this. If it's developing a widget, how am I going to develop this widget to make it more durable, or whatever the project is. So those are the kind of costs that we would be looking at. One thing to note, if you're doing software development, that is explicitly part of this, unfortunately. So that's a clarification that helps us, because for when I think about it for R&D purposes in 174, that isn't necessarily always the case. Okay, so in terms of what costs are we talking about? So you have this activity that has uncertainty. What are the costs that we need to capitalize? So it's the costs that are incident to the project. So we look at things, this is a much broader group of costs than for the R&D credit, which the R&D credit is limited to only 3 costs: the people doing the work, whether they're employees or contractors, and then supplies that are consumed during the project. So this is much broader and includes things like the utilities, drawings and models. If you have an attorney that maybe does a patent application for you, that the legal fees there would also be included, and we would then need to capitalize. Okay, so so that is really the capitalization. So again, that is effective for 2022. So we will need to be doing that. Effectively, since this law came out, pretty much any legislation that was tax legislation at one point had this, taking this back out of the code, but that's been pulled. So every time we think we're not going to have to do this, then we are disappointed. So that's kind of where that's at. So at this point, we expect we will have to do it, but there is this glimmering, this little hope that maybe we won't. Okay, so moving on to better news. For Missouri taxpayers, businesses that are doing R&D, there is going to be effective and starting next year, so 2023, an R&D tax credit. That we haven't had one of those in Missouri since 2004. So at a state level, that's a good thing to encourage our businesses to be doing R&D. So again, it starts next year. There is a 12-year carryover if you do take it. The good news about this, so if you're maybe a startup business or a business that isn't earning money, they are transferable, so you can sell them. So that's good news. It would flow through if you have a flow-through entity. Okay, and that's, yeah, the other news, it isn't permanent. It's set to expire in 2028 currently. I'm not going to get too far in the weeds in terms of how it's calculated, but essentially you look at the current year research expenses and compare it to the average of the prior 3. And then to the extent that's higher than that, you get a 15% credit on that. So 15% of that. There are limitations on this credit, both at the taxpayer level and aggregately amongst all the taxpayers that file this, which is disappointing to me. But so in terms of at aggregately, if you do take it, There is a limit of 10 million. So the state puts aside $10 million. So of that, 5 million has a preference to minority-owned businesses, women-owned businesses, and small businesses. So just keep that in mind, that even if we do calculate $100,000 credit, yours might end up being limited. Lastly, I just wanted to point out, Missouri also has a new sales tax exemption, which isn't my area so much as Laurie's, but has a sales tax exemption for R&D equipment. So if you're purchasing equipment used in R&D, you might be eligible for an exemption of the sales tax on that purchase. So does anyone have questions for our group? Yeah, absolutely. So Alan just was referring to when Wendy was talking about one of our tax strategies, which is a good one we use all the time, bunching your charity. You know, maybe if you're looking at a 3-year period and you give $20,000 a year, you give 60 in that 1 year. So the planning point is you can set up a donor advised fund that first year and contribute 60,000 in. And then you have control over when to donate that to the charities of your choice over those 3 years. So that then, to Alan's point, you don't have the, if you gave the charity directly the 60 that 1 year, they may want more in year 2 and 3. So very easy, very easy. You mean in terms of opening up a donor advised fund, a charitable fund? It's very easy. I have one. You just, Fidelity has them. But essentially it's just, it was as easy as opening up a checking account for me.
The standard deduction is about $26,000. You get a $10,000 deduction for state and local taxes. So let's assume everyone gets that. Absent having mortgage interest, there aren't any other itemized deductions that you would have. So effectively, until your charitable donations exceed $16,000 a year, you get no benefit. So that's the idea behind grouping them into 1 year, where say if you give $15,000 a year, you could give $15,000 a year and never get a benefit under the current tax code. But if instead you gave $45,000 in a year to the donor advised fund, you get to deduct effectively 30-some thousand of it.
All right. Thank you all for joining us. We appreciate it.